Hey everybody, Kurt Henry here, mortgage broker at the Mortgage Center. We're your go-to mortgage broker in the Durham region, and this is a weekly mortgage market update just to let you know what's going on in the mortgage market. One of the main questions we're getting right now is how should we prepare for an economic downturn? And we believe there's 3 points that you should consider on this question. Number one is to check your cash flow. Check your cash flow means to look at all the money coming into the household, look at all the money going out of the household. The idea is to maximize the money coming in and minimize the money going out. One of the ways to minimize the money going out is to look at your monthly debt payments. Sometimes there's ways where you can consolidate or restructure some high payment debt and put it into low payment debt. Whether it's your mortgage payment, car payment, loan payment, credit card payment, any other loan payment, there's different ways of restructuring that some high payment debt and putting it into low payment debt. Of course, we can help you with that, so feel free to reach out if you have any questions on it. The second thing we think you should consider is to check your liquidity and plan for the unexpected. Unexpected meaning things like health issues, family emergencies, job loss, etc. We know that the unemployment rate in Canada today is 4.9%, and we know that's at a record low. We also know that when there's an economic downturn, unemployment tends to increase. So the idea is, some would say, you want to have at least 3 to 6 months of expenses in your account as liquidity, so that if an unexpected event does happen, you have more of a buffer to be able to recover from such an event. Again, it's much easier to get that liquidity if you don't already have it before an event like that happens. For example, it's much easier to release some equity in your house to have liquidity while you have a job versus after you lose the job. Or it's better to do it before you get sick versus after you get sick, etc. Feel free to reach out. We can help with any of that, of course, at any time. The third thing we think you should consider is opportunities. We know that the average price of a home in Oshawa, for example, from July last year to July this year is 8% down, which is about $67,000 lower in July this year versus last year. That represents an opportunity for somebody that's getting into the housing market, for example. There might be an opportunity to buy now versus maybe when it wasn't an opportunity a short time ago. We also know that if somebody owns a home and they're looking at buying an investment property, there might be more opportunities there now versus what there was a short time ago for future wealth creation. If you have any questions on any of that, feel free to reach out. But again, the 3 items would be to check your cash flow, check your liquidity, and plan for the unexpected, and look for opportunities.